Hello and welcome to the DIY Investing YouTube channel. We're working through every company in the S&P 500, and today is Delta Airlines, ticker DAL. Over the next few minutes, I'll discuss my thoughts about the valuation of this company and its business quality. First up, this company has a market cap of $18 billion, enterprise value of $30 billion. So you can see about $12 billion in net debt on this business, which means it's taking up about 40% of the overall enterprise value, which is very, very leveraged. Operates in the airlines industry, which I tend to see as fairly low quality, but we'll see if the numbers play that out. Delta Airlines provides scheduled air transportation for passengers and cargo in the United States and internationally. Operates through two segments, airline and refinery. Has hubs across the whole United States. What does their refinery segment does? Oh, I guess this is what it provides. Aircraft maintenance, engineering support. Has about 1,200 aircraft, so very large fleet based in Atlanta, Georgia. So very large U.S.-based airline. Gives you a lot of information to think about there. Now, one of the things I like to do when evaluating companies is look at these return on invested capital charts and understand how much their time is spent, earning money versus losing money. And unfortunately, it looks like there's 1, 2, 3, 4, 5, 6, 7 years out of the last 20, they've lost money, which is a very significant number of years. That's a large number of years that I have losses. I generally don't like investing in companies that have more than 1 or 2 years of losses in the last 20 years. So to have 7, that means that they are losing money at about 30% of the time that they operate, which is very, very high. Now, what's interesting to me is when I combine this is you can see some cycles that basically there's some cycles where they make a lot of money. In 2013 earning 62%, 2015 24%, 2015 15% returns on invested capital through the 2016 to 2019 year time frame. And then of course they lost money during COVID and barely got back to even in 2021. But what I find interesting about this, besides the cyclicality, is that during normal years, they're earning pretty good numbers. Return on invested capital of 15%, return on equity of 27%. These numbers on the surface look really good. The problem is when you go from arithmetic returns, which is what this 10-year median return is, and you convert that to geometric returns, those numbers are going to get much, much lower. And the problem is that because you have these years of losses and you have these much lower numbers, when you actually average out what your returns are going to be, it's likely to be substantially worse. And I think that's where you see the difference between these 10-year median returns and these 10-year CAGR numbers. For instance, your revenue has actually gone down over the course of the last decade, negative 1.6%. You started out in 2012 with $36 billion in revenue. You end at $29 billion in 2021. Now, I don't think it's the best comparison. Probably we should compare to 2019, where you went from $36 billion to $47 billion. So you're up about 40 to 50% over the last decade. And you can see you're growing at 4%, 3%, 6%. 4 to 5% a year is probably a normal revenue growth for them. So we kind of have to ignore COVID, and it's messing up these numbers. So if we just look 2012 to 2019, we say, earnings per share look great. You went from $1.19 to $7.30. But then what happened? Look, you had $12 in earnings in 2013, back down to 78 cents, $5. You're all over the place. There's very little stability year from year. The most stability you see is from 2015 to 2018. But of course, you lost $19 in 2020, which wipes out, 3 or 4 years worth of profits. So you have to be very, very careful, because when you can have a single year wipe out 3 or 4 years of profits, you really need to understand that this is a cyclical business and very, very risky. Look, this is why they haven't been able to sustain their dividend, is they lost so much money in 2020. They had to cut their dividend. So although they had started a dividend in 2013 and been raising it every year, they ended up having to cut it because they could no longer justify it on their business. Again, one of the things you see is like, oh, yay, look, I have a nice return on equity of 27%, but you had negative 146% in 2020. It's my guess that if you hadn't been bailed out by the U.S. government, they might have gone bankrupt in 2020, or you would have seen massive dilution. We might still see massive dilution, but we're going to have to look at those numbers in more detail. PE of 30, I don't even know how useful this is because you're comparing against these old numbers. But overall, not feeling good about United Delta Airlines so far. If you're enjoying this video, please hit that like button. Don't forget to subscribe. I need you to like all my videos if you're one of my longtime viewers. Those likes tell YouTube that you're enjoying my content and recommend it to other people. Let's look at the income statement. You can see not only do they lose money on a net income year, they have a negative gross profit in both 2020 and 2021. That's pretty brutal, and it shows part of the problem here for them with that whole setup. They had to massively cut their SG&A expenses, and you can see that big drop down. That's one of the reasons they've been able to sustain a profit in 2020. One is they were able to cut that significantly there, but there's not much you can do when your gross profit goes down all the way to negative, from 12 billion to negative 6 billion. That's a huge loss for a company of this size. I mean, think about what this is. Negative 6 billion in gross profit on a company with a market cap of 18 billion. So just, again, that's a third of the equity in the business being wiped out on a gross profit basis in a single year. That's 2/3 of it being wiped out on a net income basis. I mean, this is just a massive, massive number. In terms of overall capital allocation, I like what I see that they're buying back shares. I mean, you start the decade at 850 million shares, you get down to 640 million shares. So they've wiped out, somewhere between 20, 25%, maybe 20 to 30% of their shares over the course of a decade. That gives you about a 2 to 3% boost in earnings per share over the course of a decade period. And so that is a nice use of your capital. But then the problem is what it's like it almost becomes irrelevant with these bad COVID numbers. Now you can say, okay, COVID's rare. Yeah, but it doesn't take much to wipe out a business. So you have to be very careful with a business that's this cyclical. It's not like 2020 is the only thing. Like, look at 2021. You had net income of 280 million. 2014, you had net income of 659. So you have some really bad years in here. Now, what does look good is they're not paying stock-based compensation. That's a really good sign. But they are dumping a lot of cash into PP&E. You need to do that very stably. Sometimes substantially higher numbers in PP&E than you're making in net income. I mean, these are very, very large investments as they're having to spend that money on new planes, maintenance on planes, that sort of thing. Something to be aware of there. You can see they're constantly raising debt. I need to go back to the balance sheet. Let's look at how much debt they have. So on the balance sheet, we can see PP&E, they've grown it, 50%. Again, a little bit more than 50, about 75%, going up to $35 billion. Again, they've grown their PP&E 75%, but they only grew their revenue 50%. That's not a good matchup. And I would guess their debt's gone even more. Yeah, their debt has already doubled from 11 billion to 27 billion, 25 billion. So they've doubled their debt over the course of the decade, even though they've had less than doubling in revenue. And of course, that's going to impact their ability to earn in the future. And you might say, oh, look, look up until 2019. Their debt had actually gone down from 2012 to 2019. But you have a single year of such major losses, and now you've destroyed all those gains that you had. All of that time spent reducing your debt, and now you have probably another decade or two of debt reduction just because of the 1 or 2 bad years. So this is the big risk of an airline company. For me, I would avoid Delta Airlines. It's simply too cyclical. You have too many years of losses, and the losses, when they do occur, can be very, very large. Now, not every year is going to be like 2020 with COVID, but you did have a 2008 year where they lost a significant amount of money as well. So it doesn't necessarily have to be COVID. 2008, 2009, they still lost money. So this is not a reliable business to be investing in long term. So you need to be careful, because even on the surface, you see these high median returns. I would say the company is both overvalued and a low quality company, and those two things combined together means not on my watch list, and it's a pass for me. If you enjoyed this content, please hit that like button. Don't forget to subscribe. Ring the bell so you can get notified. I'm doing 3 videos a week, Monday, Wednesday, Friday, on covering new S&P 500 companies, already done over 130. And if you click this box up here, you'll be able to see the playlist where I cover those past 130 S&P 500 companies. We're starting A, going all the way to Z. I hope you will tune in for that. If you liked studying companies this way, if you want to do a quick 5 to 10 minute analysis yourself, I encourage you to sign up for quickfs.net. My affiliate link is the first link in the description below, and I hope you will check it out. If you sign up with my affiliate link, either a free or paid account, that is a way of supporting this YouTube channel, help make me successful because I can get a commission when you sign up through my link. It doesn't change the price for you, just gives me a benefit for passing it on to them. I don't recommend anything I don't use myself, and I really like to use QuickFS for my stock analysis as I'm doing live here for you. So I hope you'll check it out, quickfs.net, description in the show notes below. Thank you for listening, and until next time, stop paying fees, start building wealth.